Let's now look at what are the differences in characteristics between stocks and options. We know that options are a separate instrument from the stock. Options are traded on their own exchange and stocks have their own exchanges. The main difference between a stock and an option is that stocks are what you can call as being single dimensional. So what do we mean by that? What we mean is stocks have only one dimension, and that is the price of the stock. That is the current price of the stock. You can buy the stock at that price, or you can sell the stock at that price. You can't really buy or sell that stock at prices that are very different from where the stock is trading at the moment. You could put in a limit order to buy at a price that is very different from where the current price is, or you could put a limit order to sell the stock at a price that's very different from what the current price is. However, you're not guaranteed an execution or a fill on that order. So unless you put your order in at a price that's very close to where the stock is trading, you're probably not going to get filled on your order. So that's what we mean by single dimensional. And that dimension is the current price. So if Apple, for example, is trading at $500 a share, you could put in a buy order at 500. You may be able to get away with a buy order at 495 and still get filled if Apple goes down a little bit. But if you put in an order at 450, you're probably not going to get filled on that order. Your order will remain open until Apple falls to that level, and only then is it going to get executed. So that's what we mean by stocks are a single dimensional instrument. Options, on the other hand, are multidimensional. So even if Apple is trading at a price of $500 a share, you could today get into an option contract to buy or sell Apple at a price of 600. You could get into a contract to buy or sell at 400. You could get into a contract to buy it at 550 or 450 or any other prices in between as well. So these are contracts that you can get into today for a price that's very different from where Apple is trading currently. And these contracts can be valid for a few days, could be valid for a few months, or even a year from today. So whatever contract you enter into has to have this finite time element, and this is what we mean by the expiry date. But you don't have to trade the stock at the current price where it's trading. You can get into contracts whose prices are very, very different from where the current price of the stock is. So if you're getting a little mystified by all of this, then you can imagine how interesting this scenario is. And that's the beauty of options. You have plenty of options. So you might actually think, why are these instruments called options? And they're called options for that reason, because you truly have 100 different options to play the stock of your choice. And with options, what you're really doing is, especially if you're buying an option, you're paying to have some kind of a choice in the future. So whether it's a choice that you want to buy something, the shares, the underlying stock, or you want to sell those shares, whatever the case may be, you're paying to have a choice in the future. So welcome to the world of options, the most fascinating instrument in the financial markets. So next, what we're going to do is I'm going to go into the definitions of an option, and then we look at the definition of a call option. Now, this is the part where you really need to hang in there, because we do have to get through these definitions first. It may or may not make sense to you, and that's perfectly fine. Most people when they learn options, they start from these formal definitions and then they try to grapple with this formal definition all along, and this is where they have an issue. Whereas what we are going to do is we're going to just touch upon this formal definition, and once you've gone through this, we are going to look at a call option using a real world example of buying a house. And that's where you're going to completely understand what this formal definition means. So options give the buyer of the option the right to buy an asset or sell an asset at a certain price, which is called the strike price, by a certain date, which is called the expiry date. The right to buy an asset is a call option, and the right to sell is a put option. Now, in this course, we are only going to look at call options. But let's look at this definition again. Options give the buyer the right to buy an asset at a certain strike price by a certain date. So if you recall on the previous slide, we said that you could buy an option contract for a price that was very different from where Apple was trading. So if Apple was trading at $500 a share, you could create an option to buy or sell Apple at a price of $600. So that $600 price is called the strike price. And of course, all options have to have an expiry date. So whether it was a 6-month option, whether it was a 3-month option, whatever the case might be, but this particular option will have an expiry date. As we covered previously, options are derivatives. Their prices are derived from the underlying asset. And the underlying asset could be a stock like Apple, could be an S&P 500 index ETF like the Spiders, the SPY, a currency like the Euro ETF, FXE, or the Gold ETF, GLD. So you can have options on anything, on any kind of an asset, as long as that underlying asset has some kind of price uncertainty to it. So the prices of that asset must be moving. It must have that particular characteristic for you to be able to create an option on that asset. Let's now look at the definition of a call option. We covered that briefly. The buyer of a call option has the right, but not the obligation, to buy the underlying stock at a certain strike price by a certain expiry date. On the other side, the seller of this same call option has the obligation to sell the same stock at the same strike price by the same expiry date. So the buyer and the seller have opposite sides of the contract, and you'll see that their risk and reward profiles in this contract is also exactly the opposite. So the buyer has rights and the seller has obligations. And this is a big difference. And even if you don't understand the big difference right now, that's okay. That's what we're going to cover throughout this course. So there's a buyer of an option and there's a seller of an option. And the buyer has rights and the seller has obligations. Okay, let's move on and look at what are the factors that might affect option prices. So imagine you have Apple that's trading at $500 or $525, somewhere. That's its current trading price. And then you have the strike price of an option, say it's at either $600 or $300, it could be any price. If you have Apple trading at $525 and you wanted the right to buy Apple at $600, what do you think are some of the factors that could influence the pricing of the option? Well, one is very clear. One is, what is the current price of the underlying stock? The current price of the underlying stock is $525. Then, if Apple moved towards $600, obviously the price of your option is also going to move, because now Apple has a better chance of hitting the strike price of $600. The other factor, the second factor, is volatility of the underlying, or in broad terms we can define volatility for right now, we can define it as the ability of the stock to move around. So if you look at two stocks, say for example Apple and IBM, IBM is a very stable stock. It's not very volatile. So in terms of standard deviation and its statistical movement, IBM has a volatility of about 15%, whereas Apple is a much more volatile stock. Its volatility is defined at around 30-35%. So you can say that Apple is twice as volatile as IBM is, and therefore the price of your option is going to depend on this, because if IBM was trading at 525 and Apple was trading at 525, and given that IBM is half as volatile as Apple is, the chances of IBM hitting 600 is going to be much less than the chances of Apple hitting 600. So volatility is a critical component in option pricing. The third big component is the time remaining to expiry. So let's say you bought the 600 call option when there was 1 month left for this option to expire. And let's say you compare that with another option at the same strike price of $600, but this option had 6 months to expiry. Which option do you think is going to be more expensive? Or do you think there's not going to be any difference at all? Well, I think, intuitively you can see that the 6-month option is obviously going to be more expensive, because Apple has a very good chance of hitting 600, and therefore the seller of this option is going to get worried about that, because Apple may go to 650 or 700 in 6 months, and the seller of this option is going to face a loss. Therefore, the time remaining to expiry is also a very important factor. And always, if there is more time remaining, then that option is always going to be more expensive than a similar option which has much less time remaining to expiry. Then there are two mostly insignificant factors that go into all options pricing models. One is the risk-free interest rates, and two, the dividends paid by the stock. Now, in both of these cases, the impact these two factors have on the options price is very minimal. So although all options pricing models input these values into their models, as a practical matter for a trader or an investor using these stock options, these two factors are almost always ignored. Okay, so now you have a basic concept of the differences between stocks and options, and what is an option, the definition of a call option. The call option is a right to buy. Remember that. The call option is a right to buy the stock at a certain strike price by a certain date, which is called the date of expiry. Now, what we are going to do is jump straight into this real world example, which is a real estate deal. We are going to act as the buyer of a house, and we are going to create a call option and then look at the various scenarios from that perspective. This example will make it absolutely clear what a call option is.